been looking at the new home sales data and saying like, oh, maybe it's picking back up again. That's not really the complete picture. Really, the statistic that you want to be looking at for the quote unquote health of the housing market is total home sales, because only about 15% of total home sales are new homes, 85% are existing homes, right? And inventories are very, very low in existing homes, which is squeezing activity into new homes, right? If I were to go out and buy a house today, it would be much easier for me to buy a new home than an existing home. So that dynamic is benefiting home builders and new home sales.
My name's Max Gagliardi, and this is Always Be Building. If you're watching this video, take a moment, hit the subscribe button on YouTube, or you can follow me on your favorite podcast app. Hope you enjoy the show. Mike, welcome to the podcast. Thanks for coming on.
My pleasure, Max. Thanks for having me.
For the guests that don't know who you are, just quick background and tell me about your company.
Sure. I'm the senior analyst and principal at Invictus Research. We provide macroeconomic and market strategy research to a variety of customers, from retail customers and hobbyists to financial advisors and even a few hedge funds. So our mission is to make macro simple, to make it accessible. We deliver our content over video rather than through long, boring PDFs. And that's sort of the long story short.
Well, it's good stuff. I've recently came across your work and I've watched a couple of your videos. It's stuff that I love. I mean, I talked to you about that briefly before we got on. I mean, this is the kind of stuff that I kind of nerd out on and I like to look at every week and follow guys that are a lot more in tune with it, like you, that can break it down and give us, the high level stuff, but also get into the weeds if we need to. What got you into doing this? What was your background prior to starting Invictus?
So prior to starting Invictus, I worked at an investment firm called Broad Run Investment Management. And Broad Run, it was a fantastic experience. I learned a ton there, had a lot of independence, got a lot of responsibility, no complaints at all about Broad Run. That said, their strategy was a little different from Invictus. It was much more bottom up in nature, much less top down. And so all of my time was spent doing diligence on businesses, right? And figuring out their competitive moats and their growth runways and talking to management teams and so on and so forth. And the senior partners at Broad Run were fantastic business analysts, some of the best that I've ever met across the street. And so, I was very excited to learn from them. And like I said, it was a good experience, but something that I learned over my time in the business and working with them was that it's really not all about the individual company in terms of the price action, right? Even over long periods of time, it's not just about how the company's executing or how well incentivized the management team is or the competitive advantages. All those things really do matter, especially over the long run. But if you're a bottom-up stock picker, you just have to be willing to be wrong for a really, really, really long time. And of course, there's always the chance that you get your bottom-up thesis incorrect. Risk management for a bottom-up manager is really, really challenging, because how do you know when you're wrong? You have to be incredibly, self-possessed and humble. And a lot of times by the time you realize that your thesis was wrong, you've already lost a bunch of money. So it's incredibly, incredibly challenging. So anyway, take a step back. I got the chance to meet a lot of really smart investors on the street outside my firm. I traveled and went to conferences and idea dinners and whatnot. And along the way, I sort of developed a mentor at another investment firm who's a little more top down in nature, a little bit more macro focused. And he was getting a lot of stuff he was getting a lot of stuff right that I was getting wrong. And moreover, he was making calls on things that I didn't have the first idea about how to forecast, things like gold and rates and commodities and so on and so forth. And I thought, after a while, I figured I have to just, sort of humble myself and figure out what kind of tea leaves this guy is reading, because there's clearly a lot that I still had to learn. And so I figured I was going to learn more about macroeconomics and how sort of fundamental macroeconomic variables drive the price action, growth, inflation, monetary policy, and whatnot. And that ended up being sort of a very fruitful endeavor for me, and really enhanced my skills at the firm I was at in terms of bottom-up stock picking and portfolio management and even my PA and so on. And after a while, I figured through a confluence of things in my personal life and having a few good years at Broad Run that it made sense to start my own firm. I thought I could create more value, opening up my research to a broader audience and just working for the fund. And that's how Invictus was conceived.
Well, props for doing it. I mean, it's tough to go and do anything on your own. I've kind of been in the entrepreneurial world for a while, and For me, it was kind of more necessity at first, and then I realized this is what I was called to do. But it's not the easiest thing. I also want to give you props for the media that you've been creating, because it's good stuff. It's high quality. For those that aren't following Mike or checking out his stuff, it's really concise. You've got good camera presence, which is hard to do. I mean, the talking head stuff is not easy. Just not saying the ums and the ahs, like what your delivery is very clean, and that's a skill set. So I think you're going in the right direction with it, and it's articulating things to people in a way that they can digest them. That's not a long PDF. And so it's good stuff, and it's impressive. I'm glad we got to connect here. Getting back to what you said about reading the tea leaves, just being able to, go high level and look at the macro. I'd like to talk broadly of what, the state of things are right now. In some of the research you talk about business cycles, and this is really big, longer term things that some people may have a hard time wrapping their head around. But then there's also things that are topical that are happening week to week, month to month in terms of data and numbers that's coming out. So I'll just kind of let you open riff on the state of things as you see them. And then I've got a list here of things we can dive into all the specifics of what you're paying attention to, but I'll let you start out with just kind of high level. What are you watching?
Sure. So first of all, thank you for the kind words. I would say if I were to describe where we are in the business cycle, we're probably toward the 7th or 8th inning. And actually, maybe I'll take a step back and sort of define how I think about the business cycle, because I think that'll help put everything that I say going forward into context. So where does the business cycle really start for us? Well, in this case, it's probably useful to rewind the clock to call it late 2021. What was going on? Inflation was running a little bit hot. The Fed was starting to realize that it had made a policy mistake in letting inflation run too hot for too long. So what did the Fed do? The Fed raised interest rates, or started to communicate that it was going to raise interest rates. What happens when they do that? Well, the entire US interest rate complex starts to move higher. And we're going to focus on the 30-year fixed mortgage rate for the purposes of this conversation, because that ends up being a really important rate. And, a lot of people might think, well, the Fed doesn't really control the 30-year fixed mortgage rate. So why does that matter? The reality is the Fed funds rate is the policy rate, and the Fed funds rate moves pretty much everything else, right? So if you ran a regression of the Fed funds rate and the mortgage rate, there's a 91% correlation between the two. So when mortgage rates are going up, you can almost always blame the Fed. That's almost always the reason it's going higher or lower. In this case, going higher, right? So when mortgage rates move higher, what happens to demand for housing? Well, it goes down, right? Because mortgages become more expensive. When mortgages become more expensive, fewer people can afford them. And it's really not any more complicated than that. The impact on demand for mortgages is near instantaneous. And this cycle, we've seen about a 56% decline. Well, actually, it was a 60% peak to trough decline from early 2021 until I think it was October, when demand for new mortgages troughed. But it's still down about 56% off of its peak. So you've seen demand for housing, or for mortgage financed housing, just absolutely fall off a cliff as mortgage rates have gone from sub 3% to around 7% right now. So what happens after housing? Well, after mortgage rates become so expensive, well, new home sales fall, right? So a lot of people have been looking at the new home sales data and saying, like, oh, maybe it's picking back up again. That's not really the complete picture. Really, the statistic that you want to be looking at for the quote unquote health of the housing market is total home sales, because only about 15% of total home sales are new homes, 85% are existing homes, right? And inventories are very, very low in existing homes, which is squeezing activity into new homes, right? If I were to go out and buy a house today, it would be much easier for me to buy a new home than an existing home. So that dynamic is benefiting home builders and new home sales, and any measure of new home sales, right? So the NAHB index is at a multi-month high. And the reason for that is it's a measure of home builder sentiment, right? So again, home builders are benefiting from this dynamic, also hence why the stocks have done so well. But in any case, total home sales are still down quite a bit. They're down about 37% from their peak. And maybe they've stabilized a little bit over the last few months, but they're still pretty low, right? The reason that matters is because really the housing cycle drives the good cycle, particularly the durable good cycle. And so what I'm talking about there is cars, washing machines, furniture, big, expensive, financeable, discretionary items that really drive the manufacturing cycle. So when new orders for durable goods go down, manufacturing companies respond by cutting production, right? That's the natural response to less demand for their goods. Now, manufacturing companies can only cut production for so long before it starts to eat into their margins. And so after that, what do? Well, they have to lay people off. I say we're in the 7th or 8th inning of this process because we actually have started to see some layoffs in manufacturing. So we've seen, if you looked at the last employment situation report, manufacturing payrolls, there are about 2,000 net layoffs in July. If you look at the ADP data, it was much worse. So the ADP data is generally considered a little bit less reliable, but they would have to be wrong by a lot for this data to not be meaningful. So we saw 36,000 net layoffs in July. And if you look back over the last 5 months, it's been almost 200,000 net layoffs in manufacturing. So I say net layoffs, meaning net of new hiring. So the reality is, in certain parts of the manufacturing economy, it's probably been even worse than that. So from manufacturing, if this is going to become a recession, that weakness in manufacturing will metastasize into the broader economy, right? Because as layoffs increase, theoretically, as the unemployment rate increases, which we haven't seen at the headline level yet, incomes will go down. Incomes go down, consumptions go down. Consumption not just of goods, but also of services. And that's how you get weakness in the services sector as well. So again, 7th or 8th inning of that process, that's where we are today. Hopefully that was helpful.
No, it's good. I like how you led with the mortgage rates and housing. And I would like to just expand on it a little bit. You did a good job of touching on the ripple effects. But as I've thought about it lately, there just seems like it pushes through to so many other things. I mean, it's like if people aren't moving or buying homes, just how much it's expensive to move. I mean, you got people buying new furniture, like you mentioned, appliances. You've got all these other industries. The self-storage industry I've heard is really down right now. There's been a lot of real estate dollars that have gone into that. That seems probably highly correlated to people moving and needing to store their things. That's the only time I've ever used one of those things. And it just seems like there's so many ripple effects there. So just, is that kind of the reason why? I mean, how big of an impact is housing and what's going on with people buying new homes and moving? Like, how much does that push through to everything else?
Well, it pushes through quite a bit. It's one of the best leading indicators for the broader business cycle. And I don't think I have any slides for you, but as evidence of that, if you took the 2-year change in the 30-year fixed mortgage rate and mapped it onto the ISM manufacturing PMI, which measures manufacturing activity, but it also leads broader measures of the growth cycle like GDP. It also tends to be coincidentally correlated with the S&P 500. It leads with a very, very close correlation by about 16 months, right? So the influence of mortgage rates on the broader economy is shockingly strong.
Well, and it makes sense in some ways too, intuitively, because the times when I've moved houses, I mean, outside of people having to move for they change jobs and they got to move cities, or maybe they're retiring and they want to downsize. But for me personally, when I've moved, it's been to upgrade or to buy a nicer house or to get into another area or to do something. And it's usually like I'm making more income. It's easier for me to say, hey, look, I can make a step change in my life and push forward with this huge financial decision. And, if things are stagnating, people are less confident, affordability is at an all-time low. There's probably, that probably ripples through as well in terms of, it's not just the mortgage rates. It's also just people are staying put. They've got really low interest on their existing mortgage and they're not going to make that big leap. So to me, outside of the ripple effects to the economy, it's also just people's sentiment and where they're at in their personal finance currently. So I think that could, potentially weigh into some of these factors as well. But like you started with the Fed raising interest rates, and it's not just the amount that it's been raised, it's the speed of it, right? And I think everybody is kind of all eyes on the Fed right now. There's a saying, don't fight the Fed. Just how have you read, what they've said recently? What do you think? Are they really going to hike again? And then kind of from that lead into your thoughts on inflation, deflation, what's going on in that part of in the yields world.
So it's a good question. And there's a lot of debate around what's the real cause of inflation. And in principle, there's really only one real cause, and that's money printing and excessive outgrowth and output, right? But you could also make the distinction between principal causes and proximate causes, right? So proximate causes are just sort of closer to the end state. And so I always hate to say something like income-driven or wage-driven inflation, because it sounds like I am blaming workers for demanding faster wages. That's not really the case. It's always a result of poor monetary and fiscal policy that workers are forced to do so. and that it results in inflation. So you could say that wage or income growth is the proximate cause, but not the principal cause. So with that out of the way, I think it's important to make a distinction between the different proximate drivers of inflation and how they change over the course of an inflation cycle. So, in 2021, the primary driver of inflation was really, fiscal transfers and supply chain issues that were causing goods inflation. And durable goods inflation and non-durable goods inflation at certain points were running 15, 20%, really, really fast, right? As a result of that, though, workers began to expect faster inflation in the future and negotiate for higher wages. And even as those supply chain issues resolve, wage-driven, sticky core services oriented inflation remains high. And that's really driven by income and wages. And you don't have to take my word for it. If you look at the correlation between the Atlanta Fed wage growth tracker and CPI services less energy, you see almost a 90% correlation going back over the last 20 or 25 years or so, right? And so we've seen a transition and the driver of this inflation from supply chain issues and fiscal transfers into incomes, right? So what is the Fed looking at? And the Fed understands this. This is a dynamic that they've talked about before. What is the Fed looking at when they think about, an income-driven inflation cycle? Really what they're looking at, they are looking at the reported inflation data. They are looking at CPI and PCE and core and services and so on and so forth. But they're also looking at consumption and income, right? And so what's driving faster inflation or stickier above target inflation? It's consumption growth in excess of production growth. What's driving that consumption growth? It's income growth, like we said a second ago. And if you look at the most recent income data, really the best line item from the report from the BEA is disbursements of wages and salaries. And that's because that's where the preponderance of income comes from most people. It's growing at around 6.5%. Actually, I think it's 6% year over year. And if you look at the 3-month annualized rate of change, which is sort of a shorter term gauge of momentum, it's comping at 6.5%. So it's not really showing any indication of slowing down. So while we have seen some relief even in core and core services over the last couple months, 2 or 3 months, call it, even though it's still above trend, the driver of that sticky inflation is not really budging. And that's what the Fed is going to be focused on. And so candidly at Invictus, we probably expect another 25 basis point hike, and we expect continued quantitative tightening. Eventually, and the reason that the Fed is going to continue to have a stance of hawkishness and tight policy is because the risk of this disinflationary impulse from energy and from goods and durable goods, when that disappears, you're going to see inflation start to gravitate more toward that wage-driven number, which is right now around 4.5%, right? If you adjust for productivity. So until that dynamic starts to ease a little bit, I think that there's a very high bar for the Fed to take its foot off of the gas.
For sure. I've asked this question to a number of macro folks that I've had on the podcast. Does the ripple effects to the supply side, you still got relatively high wages. Now you've got anything that's a high capital intensive business. It's much harder to get credit, whether that's energy, whether that's anything that involves spending a lot of money to make goods or services. That also is impacted by higher rates. Does the Fed risk, hurting supply, whether it be new homes, whether it be anything that just takes a lot of capital? And with wages staying relatively high, maybe demands staying relatively high. I mean, I guess my point is that they're trying to squash demand, but if that doesn't materialize fast enough, and could this have a ripple effect to supply to make things worse potentially?
Right. Yeah. The high interest rates impede capital formation and new business activity. That's a good question. I mean, generally speaking, that's not really how the cycle works. Logically, it makes sense, right? If I wanted to take out a loan for Invictus, it would be more expensive for me to do so today. I'd have to put it into higher returning projects to make my money back. Logically, I think the answer is yes. It's hard for me to draw a straight line between that concept and any sort of investable economic outcome. But it's a good point. It's definitely worth thinking about.
It's something I think about with energy a lot, just because my background's oil and gas, and we also do other things as well. But that's where I've cut my teeth, and it's harder to get. I mean, these things cost a lot of money. Like if you look at drilling costs and completion and labor and it's the credit cycle. Oil field services, for example, is a very tight cash conversion business. They need lines of credit. And as it gets harder to get that credit, is, the cost of borrowing goes up, activity tends to stagnate because it's just expensive. And so if it's effectively reducing supply in a lot of ways. And I heard in your research note talking about energy and how are they ready for the, energy maybe reaccelerating, oil getting a little higher, and we'll get to that topic here in a bit. But that's just how I think of it from that world. I don't know how it applies to other industries, but I do think a higher cost of capital can be pretty constrictive on supply and maybe a little bit lagging on demand in terms of people still got to drive, right? So people still take flights.
It's interesting that you say that, because low rates in general did not really work in terms of spurring faster growth or better productivity. Actually, if you look back at the data, you tend to see higher rates lead higher productivity, which you could think of a variety of economic reasons for that. I'm inclined to think when the hurdle rate for return on capital is higher, capital tends to get invested in higher returning projects, which tend to be more productive. That said, energy is an obvious counterexample, right? Because low interest rates did spur the shale revolution, right? Which was extremely productive for that industry, and ended up sort of being a tailwind for every other industry as well. Maybe a tailwind for every industry except for oil and gas, maybe.
Yeah, for
So
sure.
yeah, that's. I tend to think that lower rates tend to lead to incrementally sillier capital allocation decisions across most of the country, most sectors. Right, you tend to get investors very focused on things like social media,
Yeah.
And less focused on industrial businesses or HVAC and distribution and more blue collar work. So I think based on the last 15 years or so, my conclusion would be that ex oil lower rates doesn't really spur faster output growth.
For sure. No, that's good. That's good. Good color. I'd like to hear your thoughts on it. Everybody kind of has a different answer to that one, but just basically what you were saying earlier about the Fed is that they want to see, essentially they want to see job losses, right? Like they want to see people, they're not going to straight say that, but they want to see X amount of millions of people lose their job. And then that'll give them more confidence that the embers kind of aren't still burning underneath the timber box here, and that, that they can basically take their foot off the gas a little bit. Is that kind of the view? Is that it's like all eyes on the labor market, or is that what other things you think they're paying attention to?
Right. So how do you slow income growth? There's two drivers of income growth. There's employment gains, and then there's gains in wage growth and salary growth. The latter is really what drives inflation. So how do you get growth in wages and salaries down to a level more consistent with 2% inflation? Well, there's really only one way that we know. Well, there's two ways, actually. The first way is to increase the unemployment rate. There's an inverse correlation between growth in wages and salaries and the unemployment rate. And that makes sense because they both reflect supply and demand for labor from different angles. The other way is to improve productivity. And we can get into this conversation more if you want, but it's very, very hard to improve productivity from the top down, right? That's the sort of the nature of capitalism, is that economies tend to be more productive when they're not centrally planned.
Right.
And just given the different leading indicators and models that we use for predicting productivity, none of which are great, by the way, it's very hard to predict. They all suggest that productivity is going to be quite muted for the next 2 or 3 years.
Yeah, all the AI guys are like, AI reply guys are like saying that we're entering into this new prosperous era. And, to some extent, there are some things on the horizon with AI that could help things out. I think you mentioned the shale revolution earlier. That was clearly an example of probably unpredicted productivity in terms of, we had a lot more energy. It was a huge tailwind, I think, to the economy, especially, post 2008. It really was a nice boost that I don't think the policy makers or, the central planners probably give enough credit to. It really helped things out. But to your point, how do you predict productivity? It's pretty hard. I would say that COVID was the opposite of productivity growth, probably, like the shutting everything down and then letting people work from home. It's been interesting to see that trend kind of reverse. I saw this week Zoom is making everybody go back to work, which a bunch of people were pointing out the irony
That's
in
funny,
that.
man.
So we'll see, like, if how productivity does. What about the just interest rates, the yield curve, what's going on there, 10-year, all these different things you've talked about in your notes? Just love to hear your thoughts on what's happening in that world, and credit spreads as well.
So today's kind of a risk off day. I don't know when this is being released. So rates went down have been going down today. If you zoom out, obviously rates have been going up. And if you just look at, the 10-year yield since April, I think it's up maybe 100 basis points or something like that. So, and they're pretty close to they're pretty close to cycle highs, right? Maybe 10 or 20 basis points away. So what can we deduce from that? Well, high and increasing rates is generally symptomatic of the Fed tightening monetary conditions. And it's also generally a late cycle phenomenon, right? Why is the Fed tightening? Well, usually because inflation is running too hot, right? So what that tells you is that we're not in a new bull market. We're not in an economic recovery, because it's completely inconsonant with a Fed that's still trying to tighten financial conditions and economic conditions in order to combat inflation. That is a prototypical late cycle phenomenon. And they're doing it in order to induce a recession or a higher unemployment rate. Hopefully it doesn't get too high, but that's sort of a joke. It's very hard to thread the needle with the unemployment rate. Our leading indicators suggest that ultimately the Fed will be successful in inducing a recession. Perhaps the most famous indicator is the yield curve. So if you look at the 2-year 10-year curve, it's been inverted since, I think, last July. If you look at the 3-month 10-year, I think it's been inverted since October of 2022. And so if you look at the leads and lags in which these yield curves tend to be most accurate, it's generally about 12 months, which suggests that we should really start to see the Fed tightening from 2022 start to hit economic conditions soon. Now, there are a variety of reasons it could be or should be a little bit later. Our work at Invictus suggests that the unemployment rate will probably remain 4% or below through year end of this year, and that the impact on the unemployment rate, which is really going to be the defining variable for whether or not we see a recession, the impact on the unemployment rate will really be in Q1 and Q2 of 2024. Currently, it's at 3.5%. It sounds outrageous to say, but we think it could double from here in between today and next August, so August of 2024.
Do you think? How does the election coming up, does that play anything into these policy? Getting conspiratorial on it, but I do know election cycles, you can trend some certain things on the economy based off of those. Is this, is it a time where policymakers will allow things to get much worse, like from the economy standpoint, or will there be pressures or incentives? I mean, we can all pretend like the Fed's apolitical, but we all know that there is an element of politics involved with all central planning and these decisions, these policy decisions. But what are your thoughts about how this upcoming election, if it has any impact on some of these policy decisions?
So if you look at the seasonality of the stock market, it tends to perform very well right before elections. And the reason for that is policymakers tend to stimulate right before elections because they want to be reelected. So it's kind of an obvious explanation, if you will. And if you look at most of the government data, it suggests that that's more or less what we're seeing. If you look at federal outlays, they're running at almost 6.5% of GDP. That's really only consistent with historical recessions. In other words, the federal government is spending money as though we're in a crisis right now, even though we're obviously not in a crisis. So I guess really what this question comes down to is fiscal policy versus monetary policy, because monetary policy is very, very restrictive, right? There's no universe in which a 7% mortgage rate isn't restrictive relative to our economic growth situation and income data and all of that. But you also have the federal government, spending 6.3% of GDP. And you also have a treasury that, since the end of 2022 has ostensibly been trying to neutralize quantitative tightening through its issuance choices. That could be about to change, though, because last week we got news that the Treasury is going to issue about $1.9 trillion worth of new securities. And the mix of those securities is going to be more oriented toward, coupon issues, toward the 10-year, to 20-year, 30-year bonds. There's still going to be a lot of bills, but it's more oriented toward the back end of the yield curve than the last $700 billion of issuance was. And so what that'll do is it'll put more upward pressure on the long end of the yield curve. That will put more upward pressure on mortgage rates among other parts of the U.S. interest rate complex, which will in turn not only tighten economic conditions, but also financial conditions, right? Theoretically, that will be a considerable headwind for both stock and bond prices through the end of the year. So I got to say, I put all of these things together. It's a cocktail that makes it very difficult for me to be bullish on financial assets. And I think that you have a great alternative too, right? You have short rates upward of 5%, maybe upward of 5.5%, depending on which day it is. And I think that's a very good risk reward at this point in the cycle. I'll take a 5.5% nominally risk-free, super liquid bet on short-term treasuries all day. And then when the economic conditions change and it becomes a better bet to buy long-term bonds, or a better bet to start betting on an economic recovery, you can always change your strategy. But right now, that's what looks most attractive to me.
A lot of the wealth is concentrated in the older generation, the boomer generation. You've got a lot of savers that are now, for the first time in decades, really seeing an opportunity to make, relatively risk-free returns. Does these short-term rates going up higher, is this going to, their assets have gone way up in value the last 3-4 years, really for a while, assets have been going much higher in value. You've got a lot of wealth concentration in the boomer generation. Now these people can effectively get income just from buying short-term treasuries and things of that nature, short-term securities. So does that somehow, make more of a resistance factor for slowing down in terms of people's purchasing power and like what people are willing to spend? If you've got money and you can just park it somewhere and effectively make a salary now for a huge swath of the population who does have a ton of money that they've saved up? Or is that something that we think about at all, and how that plays through to, the strength of the consumer?
Yeah, I mean, I think on a bottom-up basis, more interest income is obviously a tailwind for spending for the people that have huge portfolios of, short-term bonds that they own. That said, the people that have that much money are not responsible for the majority of spending, right? Generally, it's the bottom half of the economic distribution, income distribution, that does most of the spending for a variety of reasons. But really, they have to spend more of their income, and they can't recycle it into financial assets because just meeting their needs is a larger fraction of their incomes. And so, I think there is a marginally stimulative effect to higher household net worths and higher asset prices and maybe higher interest income on treasury holdings. But I don't think that that's going to be enough to change our cyclical outlook, so to speak, right? I think that there's stronger forces at work in the economy putting downward pressure on economic growth and spending.
It's interesting.
And even though consumption is still very high in nominal terms, and it's high relative to output growth, which is really the most relevant way we can interpret the data, it is declining in rate of change terms. And of course, if the unemployment rate starts to move higher, that'll reduce incomes and consumption in a much more rapid, nonlinear way.
Yeah, that's good. That's good points. What about the global picture? We've talked a bunch about the U.S. Anything, just commentary around what else is happening around the world? I mean, we've obviously got a big war going on in Europe right now, which has seemed to kind of fade into the background. Weirdly, it's just been happening for a while, but not seeing as many headlines there, but it's still going on. Obviously, there's impacts to commodity markets, et cetera, the grain issues that are going on with Russia and Ukraine right now in terms of what they're doing with the grain shipments. And just, there's a lot of macro things happening at the global level. China there's a bunch of interesting things happening there, in my opinion, but just your thoughts. You can dig in any one of those regions if you want, or what are you paying attention to at a more global level?
So I would say one of my favorite categories of indicators for global economic health is just looking at the commodities market. And the reason that I say that is because every liquid asset market that macro people look at is a financial market. In other words, they're discounting mechanisms. They're made up of speculators who are buying and selling on the basis of expectations. And the one exception is commodities, right? Because there's a physical market. There's an industrial market. There are people that want oil, oil to power a factory, or copper to build cars, or whatever. And they're participating in that market just the same as you or I might, or a hedge fund might. And so consequently, if you want a really good gauge of the growth of the global growth cycle, you can look at the price of oil, or you can look at the price of copper. And I think if you want an even better picture, you look at the year-over-year rate of change in those two commodities, right? And that's why copper is called Dr. Copper, right? Because it's got a PhD in economics and it tracks the global growth cycle. So if you look at cyclically sensitive commodities, oil, excluding maybe the last month or so, copper, aluminum, tin, lead, whatever, they're all moving down in rate of change terms. And what that tells you is this downdraft in the growth cycle that we're seeing in the US is not just a US phenomenon, it's a global phenomenon. And if you were to look at the European PMI data, manufacturing PMI data, it is atrocious. I mean, I think the last print in Germany was 38, Germany being sort of the industrial powerhouse of the Eurozone. it's not a good economic situation in Europe either. Something else I would just point out as an observation: there are a lot of macro folks that like to talk about whatever's happening internationally as a primary driver of what's going to happen in the U.S. And the reality is usually it's the other way around. The U.S. is still the largest, most important economy, certainly the largest consumer of virtually everything. And so generally it flows the other way. What's happening in the U.S. On the ground level economically, but also in terms of financial markets and Fed policy tends to flow out toward everyone else.
Yeah, no, that's good. I think the commodities market is is a great proxy there, and it does seem like the trends that are happening here are pretty much, at least in the economies that we have relative transparency in, it seems to be kind of on a similar trajectory. Europe's had some serious struggles in the last 18 months or so, from an energy standpoint, and then that flowing into the manufacturing stuff in Germany. It's been a bit of a dumpster fire there, and then you've got the war, and there's a lot of uncertainty around things, but when I look back at the history, and I'm like, more of just a hobbyist when it comes to the macro stuff, the other day, and I've asked this question to a few other folks as well, but if you look at like the history of inflation, at least what they've shown is CPI, and you track what's happened after these big spikes. I mean, if you kind of take out like the 70s and 80s out of the data set, a lot of these times, especially when there's been a big world event like a war or something that's happened, and you see inflation spike, and then it seems to kind of fall off a cliff and even go deflation there for a while afterwards, and then be much more subdued. I mean, albeit the 70s and 80s was a different story. But just your thoughts, like maybe give the case where you say, okay, we really go into a deflationary, I don't want to say spiral, but things, prices really actually start to come down and the Fed has to pivot the other way. And then maybe give your case for, no, actually inflation is going to stay elevated for a while. If you had to make one for both of those.
So that's a really, really good question, right? Are we going to see, a 10-year period where inflation is closer to 3% rather than 2% or 1.5%? I'd say that extends a little bit beyond where we can have a really confident view. I'm inclined to say that I think inflation probably returns to 2% and, maybe even a little lower over the long run. And the reason I say that is, what were the primary reasons that we saw such fast inflation in 2021 and 2022? Well, it was supply chain shocks. Those have more or less resolved. It was money printing. Money growth, no matter how you measure it, is sharply lower and in some cases negative. Are we going to see repeats of those inflationary drivers over the next 10 years? Probably not. And I understand that there are some good cases for faster inflation going forward. I think underinvestment in energy resources is clearly one of them. But that wasn't fundamentally the driver of inflation this cycle. Or if it was relatively small. So my base case is probably that the Fed is able to get inflation back to 2% or even a little bit lower over the long run. I don't even know if policymakers agree with that. If you listen to the ECB, or really more the ECB, they seem to be preparing investors for a future with higher inflation. Chair Powell has been extremely clear that he thinks inflation can and will go back to 2%. And I don't know. I'm probably more inclined to believe him.
I tend to lean in that camp too. You read a lot of doom tweets on Twitter where it's talking about inflation is going to go crazy, hyperinflation, but it's kind of hard to have it both ways, right? Like it's like out of one side of someone's mouth, they're saying we're heading into this crazy recession, I guess. But then at the same time, inflation is going to go crazy. I mean, I guess that's like a stagflation type of scenario, but it's just kind of hard to have both. I mean, you can, but on one hand, if like everything's getting weaker and, policy is really tight, but on the other hand, I don't know. To me, it just seems like it seems like it is coming down. And I tend to think that it'll be down further than people think it will, but I could be wrong. Just intuitively, outside of the, that era that I mentioned where it stayed high and elevated, a lot of other times, which albeit they were a long time ago, the credit was different then, we didn't have as much debt, fiscal things were different, but, tends to be, it comes down rather sharply after these big events. I mean, COVID was kind of like, it wasn't a war, but it was similar to what you'd see in like a war scenario where everybody prints tons of money and the economy's kind of shut down, right? I mean, that happens whenever there's these big world events. And so if you wanted to look at, I've heard people compare it to kind of like the 40s. So anyways, it's interesting to see how that plays out. But Moving over to energy, because we've talked about it some. It's a background that I'm close to. Just your thoughts on the recent move up in oil. And this is August 8th for anybody, 2023 for anybody listening. And we'll probably release this next week. So maybe a week stale, but relatively topical for listeners. So just your thoughts on what's been happening lately and what you see the trends going forward.
Sure. So back to your last point for just a second. It's obviously very hard. It's very hard to make a good estimate about how severe a recession will be. I will say the speed and severity of a recession tends to be commensurate with the speed and severity of the interest rate hiking cycle that preceded it. And so by that logic, we have seen a very aggressive tightening cycle. We should expect to see, I think our base case should be, at least an average recession, possibly a worse than average recession. There are obviously other variables besides interest rate policy, but I think that's worth keeping in the back of your mind. On oil, so this is what I would say about oil. Obviously, oil has been deflating for over a year now, pretty aggressively. It was, I think it peaked, its top tick was maybe $140 a barrel or something. Maybe it was 130. Anyway, very, very high. And I think it went all the way down to 70. And so it was almost a 50% drawdown. Over the last month, we've actually seen the first significant rebound in the spot price of crude, Brent crude. We saw a 13% month over month increase. Why do we care about that? Well, we care because oil is a very, very good leading indicator for inflation. Most good inflation forecasting models, oil is a primary input. It tends to lead CPI inflation by about 3 months with a 75% correlation, which is nice. It's a good thing to have in your back pocket. And so what that implies is the price of oil will be putting upward pressure on inflation. And this is at the same time that the base effects are going to become more challenging for CPI inflation, because that June print from last year is now rolling off. And that was a 1.2% month over month print. There's virtually no chance we see anything like that again. And then as a 0.0% print, I think, that followed thereafter. Almost no matter what, we're going to see a higher than 0.0% print month over month. And so the result is it's going to look like inflation is hooking back up toward 4% in year over year terms. This will probably really be for the August and September print. But the question that I'm posing is, are investors ready for a world in which the headline inflation number looks like it's moving back from 3% up toward 4%? And are policymakers ready for that? Because the chances are it's going to be happening right before the September meeting, right? Or perhaps right after. And I think that that's going to be, it's going to be hard not to hike rates against that inflation backdrop. And so I think that's something that investors should generally be more aware of, because right now there is a lot of complacency about the disinflation that we've been seeing over the last year. And I'm saying that as someone who was very vocally a disinflationist last June when it was quite unpopular.
Yeah. What about the lagging shelter data? Does that offset it? I mean, I guess, are you differentiating between core and CPI, but like the lagging, housing and shelter data seems like that's starting to flow through. I've read a lot about people saying that there could be shocks to the downside when that's fully baked in. I hear the back half of this year. Does that offset it at all, or are they going to be paying more attention to the core side?
It's a good question. So I think we have to take a step back and think about, again, what's really driving this inflation. And if you agree with what I said earlier, that it's an income-driven inflation dynamic that we're seeing right now, and that the reason we're seeing core and services remain elevated is because income growth and wage growth remains elevated, then what that implies is, owner's equivalent rent and rent of primary residence coming down in rate of change terms won't actually affect the headline numbers all that much. And the reason is because people will just spend that money elsewhere, the incremental savings that they get. Generally, Americans don't save that much money. It's been less than 5% of their monthly paycheck. Excuse me. Not used to talking this much.
No worries.
Americans don't really save that much money each month. It's been less than 5% for the past several quarters, right? And so if you're assuming that declining rental inflation is going to put downward pressure on the headline data, then what you're saying is they're going to take that incremental savings and they're just going to put it in a checking account. I think the reality is that they're probably going to spend it elsewhere. And unless there's an increase in unemployment or an increase in productivity, you're going to continue to see elevated inflation data.
Yeah, that's a good point. Although those student loans, though, those are kicking back in. Some of these renters got to pay those, but
Yeah, that'll be a disinflationary impulse. You're right. You're right, and there are a lot of variables, which is why I think it's important to really focus on um, the big ones that are going to move the needle the most. Because you can in macro you can get incredibly confused trying to square every number, and
right.
it'll give you a headache, and you'll end up, unless you have some sort of filter for processing all this information, you'll end up being over focused on the stuff that doesn't matter as much.
For sure. One thing on the energy side that I don't know why I'm surprised, but natural gas prices, just the precipitous fall that they've had, and I'm very close to that market with what I do day to day. It just seems like, there for a while. We had this breakout last year. Last year didn't feel real, and that was driving a lot of the pain in Europe in terms of, I think that flowed through to quite a bit of different industries and sectors. And it even caused the government to have to print even more money over there to give people stimmies to offset some of those high energy costs. But we've seen those come down a lot, and I think it's reinforced the idea that although maybe shale oil potentially has peaked or has slowed down to a much slower rate of growth, that the natural gas side of the story is that we have decades or hundreds of years or more of very, very cheap and abundant energy there. And we're seeing, power gen hit new records for natural gas, which should flow through to utilities at some point, utility bills. I mean, that stuff typically lags, but I definitely think it's going to be a tailwind for Europe if prices remain low. I think it's going to be more volatile into the future, but it does seem like that side, at least of the energy equation, and to the extent that this energy transition is or isn't happening, could be something that's relatively either disinflationary or at least stable for prices. If nat gas, which is becoming such a base energy for the world, continues to stay lower. I don't know if you guys track that at all, or that factors in, or if you're just more focused on crude.
So candidly, we do spend less time on natural gas, and the reason is because natural gas is notoriously difficult to trade.
Sure.
And
Yeah.
so there's less client interest, and then there's less interest on our side in introducing our clients to a notoriously challenging asset that has I think it's called the Widowmaker.
Yeah. They call it the Widowmaker for a reason, right?
Yeah, right. And I have limited experience with that, but the experience I do have, I'm not anxious to get back to it.
Yeah, I think I mean, my general take on it is that we have a ton of it. It's going to remain relatively affordable. I mean, if you look at it on an inflation adjusted basis, it is ridiculously cheap compared to where it's been historically. And that could be something that, although oil is harder to move upwhole and it's a liquid, so it's just a harder resource to get out of the ground and to produce longer term. The natural gas story to me is a very abundant and cheap source of energy that should be somewhat of a tailwind to the extent that we continue to use it here in the US and around the globe, which I think we will. But moving off of the energy side of it, just think about equities for a minute. Talk about what's been happening this year. Again, it's August 8th, so the timestamp for people. But what are you guys paying attention to in the equities world? What's that telling you broadly in terms of that relation to what's happening to the macro, and any thoughts on moving forward, what we should be looking at?
So when we think about equities or any other asset class, we really think about them from the perspective of just three variables: real growth, inflation, and monetary policy. And those three variables tend to move up and down like a sine curve. Those three variables are the three subcycles of what we call the larger business cycle. And the reason that we focus on them is that they drive the vast majority of the price action for most macro asset classes. So that's stocks, but also bonds, commodities, and currencies. And bonds tend to be more sensitive to policy. Stocks tend to be more sensitive to growth. But those are the three variables that pretty much move everything. And not only do they drive the performance of the major asset classes, but they also drive performance dispersion within the asset classes. So sector performance, the performance of style factors like growth, value, large cap, small cap, high beta, low beta. So that's always all the economic analysis that we do is put into the context of that growth, real growth, inflation, and monetary policy framework. If it doesn't affect one of those things, then it's probably just noise. So where do we go from here? Well, let's think about why stocks have gone up in 2023. So the short answer is mostly policy. So what policies have been a tailwind for stocks in 2023? The first was, ironically, the debt ceiling, right? It was a Treasury General account drawing down that injects reserves into the financial system. It puts downward pressure on interest rates. which tends to be a valuation tailwind for stocks, right? So everyone was talking about the risk of the debt ceiling. And what I think very few people appreciated was that it was in fact a boon to stocks. It wasn't a risk, it was an opportunity.
Right.
The second policy driver of equity performance this year was the banking crisis, another risk turned opportunity. And the reason is that the Fed had to turn on the money printers to deal with it, right? It expanded its balance sheet to provide these emergency lending facilities to regional banks that, injected more reserves into the financial systems. Again, it's a downward pressure on rates. And it was stimulative for stocks. And since May, we've actually seen continued performance from the stock market as though the Fed were continuing to stimulate, even as policy tightened. That price action, it sounds like a cop-out, but we don't see a fundamental driver for it, right? And a lot of it has been concentrated in stocks with exposure to artificial intelligence as a theme. And so, this could be the beginning of an artificial intelligence bubble. We've obviously seen a few risk-off days, which, in the very short term undermines the bubble thesis. But when you see stocks or any asset performing a certain way, and there's no explainable fundamental driver for that performance, that's characteristic price action of a bubble. So it's something that we're paying attention to. And it's one reason that we really don't want to, we've been opportunistically long certain parts of technology, but it's a reason that you really don't want to short technology until the trend starts to break.
Right. Yeah. Especially, people got really, really bearish on tech last year. Obviously, energy was a good play. I don't do a lot of equities in investing other than passively, but it seems like long term, it's hard to bet against technology, and the AI stuff feels overblown, but the underlying trend seems like, it's going to continue, I think. So it's just been interesting to see how much the NASDAQ and some of the tech stuff has propped up the markets this year. I've had some equity analyst guys on talking about how if you remove a couple key stocks, it really paints a much different picture with the S&P and what it's done. So it's anybody's guess. It doesn't, to your point, it feels a little unwarranted that it's performed as well. The markets have performed as well as they have, but we'll see here as some of the layers of the onion get peeled back with the data over the rest of the year. Unless you have anything else on equities, I was going to move to gold and into Bitcoin, because I've heard you talk a little bit about both of those, and would love to get your thoughts here on the pod.
Sure. I'll give one quick caveat to the bubble comment that I made a second ago. Historically, recessions are the pin that pricks the bubble. So if you're interested in going along the bubble, because, historically bubbles have been good opportunities for making money, you just have to have a view on recession timing, and you have to be open-minded, and you have to be willing to practice good risk management. And again, our expectation is that the unemployment rate creeps toward 4% at the back half of this year, but the really nonlinear break will probably be in Q1 or Q2 of 2020, or really Q1 and Q2 of 2024.
Yeah, that's good. What about gold and Bitcoin? What do you I think I've heard you talk about Bitcoin, maybe a little bit about gold on your note, but just any thoughts on with price action there and what's going on?
So gold, we'd like to get bullish on it, but it's below $2,000 an ounce. That's sort of long-term support. We don't like to buy stuff right below support, right? That's a recipe for headaches and for losing money. And we like to buy breakouts. And so we're waiting for that breakout. And that's kind of our technical overview of gold. On a more fundamental level, look, gold trades inversely with real rates. It's almost a 90% correlation going back decades and decades. So it's pretty reliable. We've seen rates go up over the last few days, and since the Treasury issued that press release saying that they were going to issue $1.9 trillion in new securities over the next 6 months. That's an upward pressure on rates. And until that alleviates, I think it's hard to imagine gold breaking out of that important $2,000 an ounce level of resistance there. So, generally speaking, deflationary economic regimes where growth and inflation are slowing are good for gold. The one time that it's not is when the Fed is continuing to tighten policy for whatever reason, and that's what we're seeing right now. And really, the Treasury is doing some of the Fed's work right now with their issuance choices, and the fact that a lot of their spending is legislated, right? So things run over budget or whatever, and they end up having to issue more than they expect. But rates higher usually is a headwind for gold. Until that changes, it's tough for us to be too optimistic. On Bitcoin, Bitcoin is really a great macro asset. And what I mean by that is it trades with a very close correlation to the real economic growth cycle, In other words, it does very well when growth is accelerating, and it tends to do worse when growth is slowing. And then it tends to have a very close correlation with different policy variables as well. And you could simplify that to interest rates or real interest rates. Generally, Bitcoin does much better when rates are declining, just like with gold, just like most financial assets, to be honest. And so our view on Bitcoin, again, I think it looks like a decent short here. I'm bullish Bitcoin long term. I want to be bullish Bitcoin. I like what it represents, blah, 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 right? But the reality is right now, the macroeconomic backdrop is not friendly. Growth is slowing. Policy is tightening. Policy is going to continue to tighten until growth really breaks hard with the unemployment rate, right? And gold is trading right beneath support around $31,000 a coin. Resistance. So generally, that's a good short setup, right? If the thesis is wrong and gold breaks out, maybe you lose, 2%. But if you're right and gold trades down to $20,000 a coin, then you've made 33%. So right. Again, hard for us to be bullish on Bitcoin tactically here.
Yeah, it's a tough one. I mean, for those same reasons, I think that I, again, like it long term. In the near term, it feels a little scary. It seems like, historically, you could see another big drawdown looking at what it's done in the past and then maybe a breakout from there. Although it does seem relatively resilient. Same with gold as well, given what the Fed has been doing. But again, you've got the NASDAQ pumping and equities kind of pumping. So it's like, is it just getting caught in the broader sentiment where people are at? So it'll be fun to watch, but and then you got the halving cycle with Bitcoin coming up, so there'll be less supply. Again, is that overblown? Next year, I mean, I think long term, clearly the supply matters, but like in the near term, is it overblown, and what that'll do to price, we'll see. But something that I'm excited to see how it plays out. We've covered a lot of what I have. We've just got a few minutes. Is there anything else that we haven't touched on that you're interested in talking about or that you're paying attention to? Kind of give you final thoughts here. If there's anything else that we haven't covered that you want to talk about?
No, I think that was a great overview. I would add, just to complement what you said a second ago, I know that gold bulls and Bitcoin bulls are probably disappointed with their performance this cycle. I'll say that if you were to just run back tests based on how the economy and policy has played out over the last 12 months or 18 months, I think both Bitcoin and gold have performed better than you would have expected, just given their historical performance through these different regimes. So that's something to be bullish about, right? Generally, that indicates improving fundamentals under the surface when no one is looking.
Yeah, that's a good point. Well, Mike, I appreciate you coming on. It's great. Again, for people that aren't following your work, go ahead and do it. What's the best place to find you at?
So we're at Invictus-research.com. That's where you can find all of our research. That's where you can find the Daily Edge, which is sort of our flagship product. It's a 7 or 8 minute video that comes out each morning, goes over all of the prior day's economic news, puts it in the context of the business cycle, runs a few back tests, aims to really make hedge fund quality research available to everyone. And then also I'm on Twitter at Invictus Macro.
Awesome. Thanks, Mike. Thanks, guys, for tuning in.